From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, September 3rd, and you're listening to the HPS Macrocast. I'm Matt McDonald in for Tony Fratto this week, and I'm here as always with John Fagan and Brendan Walsh from Markets Policy Partners. It is Jobs Day of Labor Day weekend, which means we have a lot to talk about, but who knows how many people will actually tune in on this Getaway Friday. For the jobs data that just came out, it's a pretty big miss. BLS announced 235,000 new jobs created in August. The expectations and forecasts were more in the 750,000 to 1 million range, which is kind of what, the range that we've been seeing over the period of recovery from the pandemic. The unemployment rate actually went down from 5.4% to 5.2%. It's worth saying that there's a lot of context to the jobs report in terms of the rise of the Delta variant. We are on the cusp. This is August, so we're on the cusp of schools returning. We're on the cusp of the extended unemployment benefits running out in most states that still have it going on. So, it's an interesting moment to kind of capture that as we go into the fall. It's not the kind of job growth that we would like to see, certainly at this point in the recovery. Brendan, what do you make of it?
If you look at the details, it kind of confirms all the anecdotal evidence that we were seeing throughout August of what was going on in the economy. Yesterday we had the NFIB, the small business, they put out their employment report the day before, and 50% of businesses are unable to fill jobs that they wanted to. So I think you saw in the average hourly earnings, which were up 0.6%, where only 0.3 was expected, that we're not hiring many people. And if you do hire them, you're going to have to pay them more. I also thought it was very interesting, retail trade lost 28,000 jobs, where that had been a large, we saw rehiring of that in the early spring and beginning of the summer. Also, leisure services also was disappointing. And also going back to the Delta, healthcare actually lost 4.6 thousand jobs. That's what happens again, what we saw when ERs get overwhelmed. People leave because they're sick of doing this anymore, but also most importantly, elective surgeries get canceled. So that part of the hospital that isn't the ER kind of has to shut down. So there's really nothing good coming out of this report, especially nothing that you see in the August report that you wouldn't expect to also see in the September report. I don't think the world has changed that much that we're going to see a big bounce back come September.
It's worth drilling down on the fact that, and I think sometimes we can forget this, but the jobs report is a measure of matching supply and demand. A lot of times, I feel like your mental model of it is that, people create a new job and then they hire someone because everybody wants jobs. That's not exactly what we're seeing here. Is that, there are times when worker supply is the constraint. You continue to see hourly earnings increase in this report. I think that, it'll be interesting to see how hourly earnings progresses as we continue to create jobs, because, you have a composition effect across the types of jobs that are created that could shift on some of that stuff over time. But it's an important point that, the supply of workers and who wants a job is a big question at this point in the recovery too.
Yeah, and this is, unprecedented time. So we can't necessarily look to the past to see how it was. We do know that, 2 million baby boomers took early retirement, essentially. That, they had been working a part-time job and aren't willing. Probably most of them won't. Like they've gotten used to not working. And then have a lot of people that worked in the hospitality industry, especially restaurants, who, by anecdotal evidence, a lot of them decided that the quality of life wasn't all that good and they'd rather do something else.
Is there a possibility that August is something of an anomaly when you have a situation in which, as Matt alluded to earlier, the extra unemployment benefits begin to roll off, and there is back to school is an issue that can propel some people back into the workforce potentially? What do you think? Can September really represent a turnaround potentially on those two fronts?
I mean, my view on this stuff is that we're still, this is not the first miss we've seen in the recovery. And, if you look, July and August, or June and July added, an extra 134,000 in revisions. Average over this year, we've been averaging over 500,000 jobs created per month, which is a lot. At this point, we're still down over 5 million jobs from pre-pandemic. So, it's an interesting question. I think it kind of it goes back to some really early debates in the pandemic of if we were going to see a V-shaped recovery or a U-shaped recovery. I would argue that we've seen a V-shaped recovery, but I don't think it's like a smooth V. I mean, there's been a lot of like choppiness in the entirety of the economy, and choppiness in the stages of the pandemic and what phases we've been through as it spiked and then declined and then spiked and then declined. And then you get Delta. It's worth pointing out that the numbers right now are not good. I think that, if anything has changed a lot over the course of the pandemic, it's risk appetites. Is that, at some point, especially post-vaccine, people have made some choices to say, like I gotta live my life and I can't stay in my basement all the time. So it's interesting where we are, and you look at the pandemic numbers, is that some of this stuff in places could be as bad as the start of the pandemic. It's just that, we're not seeing job crashes because people are learning to live with it, because I don't know if COVID's ever going away.
Yeah, that's and also a lot of the hot spots are places where the risk, shall we say, the sort of risk tolerance for COVID is relatively higher, and people will tend to go about their lives and behave and as if the mask mandates haven't come back and so forth in a lot of the country. But the back to school it really is a big deal. We've sort of focused in on this, and it's one of the things that we've been expecting the Fed to be pretty cautious in its assessment of the economy here in this pivotal fall period. And the speculation was that if this number really shot the moon, right, and we were putting up like 1 million jobs or plus, there was a pretty high bar for upside expectations. As you said, Matt, the estimates were 750,000 jobs. But even if we had a monster number, the Fed might be pretty cautious based on what Chair Powell said at the Jackson Hole speech last week in moving ahead with a taper or rollback of accommodation as soon as the September meeting. And pretty clear that this number puts September, off the table in terms of an announcement of the taper.
Let me ask this from a Fed perspective: if we are seeing a job market that is, constrained by worker interest or worker supply as opposed to the usual, how does that work into the Fed's thinking on some of their stuff going forward? Because you're obviously seeing the strong wage growth that would be the driver to entice people back to work, and you could continue to see that. But it's certainly, I would think that, I think most people would say that it's not for lack of job openings that we're seeing this miss or other anemic numbers.
Yeah, I think that's fair to say. The Fed really hasn't hammered home the point of job mismatch as something that they've focused on. Lots of the commentary has been about the lower socioeconomic echelons and disproportionately impacted racial groups that have a lot more ground to make up, lagging in some of this jobs in the labor market recovery. That's certainly been a focus expressly. But in terms of what a job mismatch dynamic looks for, it means for monetary policy, I think that's going to be a question that they confront later this year. And that's really going to be shown out by September and October. If with the unemployment extra benefits rolling off, the kids going back to school en masse, and we still have some, constraints, obviously, in the labor market. If those show through in the September, October, November numbers, then I think the Fed is going to have to start sharpening their pencils on this issue. It's really not clear that, rolling back accommodation would do anything to fix that. But at the same time, it doesn't speak to a kind of, the kind of weakness in the jobs market that the Fed is used to dealing with.
Yeah,
it's also worth touching on the fact that in the same September, October timeframe, we have a lot of shoes to drop on the fiscal policy side. You have the Democrats working to pass both of their stimulus packages. You have a need for a continuing resolution to fund the government. You have a debt ceiling fight that the markets always love. So there's a lot of pieces, as we head into Labor Day. I would say it's not the jobs report doesn't really set a clean slate for what's to come in terms of a lot of clarity. And it feels like there's a lot of uncertainty on the horizon as we enter into the fall.
Absolutely. And that's been borne out in a lot of the other data. We've seen the incoming economic readings. It's not just the non-farm payrolls. A lot of the other recent economic readings have been kind of muddy. If you look at retail sales, the last couple of months have been pretty disappointing. We obviously saw some hiccups in the purchasing managers indexes in the service, but nothing really serious on that front. We've seen some sentiment indicators really gyrating wildly. What are some other data points, Brendan, that have crossed your radar screen?
The manufacturing sector, while still at high levels, is slowing down, and a lot of that is because of supply constraints. And I think, honestly, the simple message is, especially for monetary policy, is the virus is still the main driving force behind the economy. And obviously, there's not much monetary policy can do to solve that. So we're still, at the whims of these new variants, and also people's ability and willingness to get vaccinated.
Yeah, we are. It's interesting. We're not the supply chain issues that were such a big part of the beginning of the pandemic, and then the early vaccination stuff. I mean, anyone can get a vaccine if you want a vaccine in the United States, at least. And with the booster guidance, with the booster guidance coming up, the older populations that were the priority at the beginning in kind of January and February, if you the 8-month guidance, if you completed your first cycle of the vaccine by the end of September, you're going to be getting a booster. So we're actually, I think the guidance from public health on the boosters, I think the guidance is there, but the outcomes are not. We don't know if this is going to be a yearly thing or what the efficacy will be going forward. But we're actually on the cusp of appropriate eligibility for some of that stuff coming up. So that will be interesting to see how that may or may not impact the pandemic going into holiday season.
And also the children's, approval for kids under 12. And basically, my
That's
kids
right. And the guidance on that has likewise been a little fuzzy. I mean, I'm rooting hard with a vested interest, but the guidance on that has been before the end of the year.
And at the beginning of the summer, there was a lot of optimism that it would be approved in August. So they've really hit the brakes on that and kind of gone quiet, which is disappointing.
Yeah.
Well, we don't have a head to the FDA, so that might have something to do with it.
That still just blows my mind that we're in a pandemic and we do not have a confirmed.
Yeah. We have a lot of doctors. We can just pick one.
It's got to be better than nothing. All right, let's take a quick break. When we come back, we want to chat through some under the radar developments in China. And go through a little bit of while everybody has been preoccupied with wars and hurricanes and flooding and pandemic, there are developments that are pretty interesting. We'll chat on that in a little bit.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
And we're back with the HPS Macrocast. Matt McDonald here with Hamilton Place Strategy with John Fagan and Brendan Walsh of Markets Policy Partners. John, talk to me about what you're looking at in China and seeing on some of the recent trends and policies over there.
Thanks, Matt. Yeah, China is a really interesting case this year. We saw, obviously, the U.S.-China relations get pretty frosty under President Trump. The trade war was high profile. That was really the big story of 2019 to a great degree. And the expectation was that the Biden administration, the expectation we had was that the Biden administration would really continue the kind of pressure on China that the Trump administration had been putting on, this multi-front campaign to counter China's ambitions on a variety of different fronts, and with a different set of priorities and obviously a different style, much more multilateral approach under the Biden administration. And that's really what we've seen. We have certainly not seen a rollback of the Trump era tariffs. Those are still in place. The initial high-level meetings have been pretty frosty still and tense. And the approach that the Biden administration has taken, they have tried to marshal, the allies and Western democracies and Japan and some of the other regional allies against China. We saw Vice President Harris making that kind of a statement in her visits to Southeast Asia. And, we had a sense that Chinese assets were going to continue to be pressured by some of this from the U.S. side. We're seeing, obviously, the SEC pressuring Chinese companies to up their disclosure and continuing on a path that could eventually lead to delisting of some U.S. listed Chinese stocks. And so with all this going on, Beijing has actually, from their side, really slammed the private sector. So it's not just the U.S. putting pressure on them. They're now getting squeezed on both sides. And this regulatory campaign that we saw kick off really in earnest after when the regulators in Beijing pulled the Ant Financial IPO, this high-profile IPO last year. And it's really continued and intensified this year. The Didi, the ride-hailing giant, their U.S. IPO earlier this summer was spoiled by subsequent regulation, ostensibly about data security, and that stock just got crushed. I mean, it's down like 40+% from its IPO price. And when you look at U.S. listed, and this is not just an isolated incident, the pressure on Chinese internet companies, all sorts of different industries, from cosmetics to video gaming. There's a new regulation recently about how many hours children can spend gaming per week. It is a very heavy-handed approach, and this is shown through in the performance of Chinese stocks. The Hang Seng last week or recently went into a technical bear market, which is 20% below its recent high, bounced back a little bit as the People's Bank of China indicated more permissive liquidity conditions. But still, these stocks are under a lot of pressure. U.S. listed ADRs, the Chinese companies listed in the U.S., an index of that's down like 40% this year. It's an absolute drubbing that these stocks are taking, and the Shanghai Composite isn't immune to this. It's up 3% this year versus 20 plus for the S&P 500. Usually, when you see Chinese stock, a market this big, this important, such a large part of portfolios across the world doing so badly, it often you see it spill over into broader risk sentiment. But it's actually been pretty well contained this time. But that doesn't necessarily mean it will stay contained. And so we're seeing some of the systemic risks. It's not just the regulatory approach. Some of these systemic risks that are embedded in the highly levered property sector, particularly, but some of the other asset management areas in China. We saw the state-owned Huarong, which is basically a troubled asset, a troubled asset manager getting in trouble itself and receiving a bailout from other state-owned companies. But the private sector canary in the coal mine is a gigantic, heavily levered property developer called Evergrande, and Evergrande appears to be circling the drain, and the expectation for a bailout from Beijing is not there, and certainly that shows through the price of their benchmark dollar bonds is 36 cents on the dollar and trending in the wrong direction. This is a potential.
I feel like there's been speculation on ghost cities in China and stuff for about a decade that's never really materialized into any kind of crisis. And I don't know that, I mean, if it's a crisis, I'm not sure it rates today. Just there's so much that's going on that there's, as we said before, I think there's a lot under the radar here that'll have impacts to come, but that just doesn't, in terms of everything that's going on, it's tough to pay attention to.
That's absolutely right. And as you say, the scare stories about China blowing up, that started and being over levered and too much credit, those started in 2010. and it has really been a case in which that doesn't mean that China hasn't come through some really serious periods. Remember the 2015, early 2016 deflation scare when the renminbi was basically, kind of a soft devaluation of the renminbi, and an enormous amount of foreign exchange reserves fled that country. It was a challenging moment, and it's easy to think back and with hindsight and say, well, the Fed came in and the global central banks pulled back on the on the stick, and the global financial system regained altitude. But it was really touch and go back then. I was the Treasury Department, and it was a major all hands on deck risk assessment. Now, just because, we've seen Chinese and global central bankers and global policymakers, pull everything out of the fire time and time again, it's sort of the boy who cried wolf impact. So if you're sitting there and saying, China is going to have a gigantic credit problem, you don't have a lot of credibility on that score, because we haven't had an earthquake that really, takes down the system in a way like 2008 did. So it remains to be seen. They're obviously trying to keep this an isolated incident and minimize the spillover in terms of Evergrande. But this is coming at a time when, the rest of the world U.S. stocks are printing new highs all the time. And it's a increasingly glaring disparity.
Yeah, it's interesting. I mean, I think a lot of the developments in China too recently have been a big fat reminder of like the politics that impact the economy over there. I mean, the old socialism with Chinese characteristics. I feel like a lot of people interpreted that as a euphemism for capitalism without saying it. And I think, some of it now has the vibe of what it really means is that the party's in charge and don't you forget it is the vibe that they're throwing off.
Yeah, the Chinese Uber, Didi, their stock is rallying this morning on news that the Beijing city government is going to buy a big stake in their company and basically turn it into a state, effectively a state-run company.
Yeah,
that's good news for the stock, but
crazy. From yesterday, they were criticizing all the ride hailing for being too entrepreneur, and that they need to take care of the consumer. And now the government, a communist government, is going to take it over. I don't understand why that's good for a stock price.
Well, yeah, I mean, it's just because the stock has fallen so far and it's taken such a beating and pulled off of the app, basically, store over there. And they figure, well, Beijing city government ownership will inoculate Didi against further regulatory broadsides from Beijing, but you really don't know. And certainly, Didi as a private, exciting company is different than Didi as a state-owned enterprise, right? And for the long term, so this may be a near-term respite for the stock, but we'd be worried about the long term. We continue to be worried about the long term of the Chinese equities and certainly the tech sector. But one thing the dog that hasn't barked is the renminbi. The renminbi has basically stayed pretty stable, and that's not consistent with past market problems in China. The renminbi would typically start to weaken and even fall out of bed in some cases. And that really ramps up the risk, the chances of a spillover into global financial markets. So we're watching the renminbi very closely.
Plenty to keep track of going forward. Let's take a quick break, and then we'll be back with a short overview of what's to come.
Our Associates and Analysts application is open. We are looking for current college seniors interested in economics, political science, or public policy to join us for a 2-year leadership program with start dates in January, June, and September 2022. Apply today and work on the top debates and policy issues in tech, healthcare, energy, trade, and more. You can apply by visiting the careers page on our website at hamiltonplacestrategies.com/careers.
All right, we're back on the HPS Macrocast. Brendan, what are you looking ahead at?
The big event from next week will be the ECB, or European Central Bank. They have the meeting, and Europe is kind of going through a similar thing that we are. It looked like we were emerging and getting back to normal, and things have slowed down just as much in Europe as here. So they have a similar kind of decision as the Fed does going forward. Also, Canada and Australia have central bank meetings. We get some producer price index data, along with just your kind of normal consumer sentiment and manufacturing data from around the world. But the central bank meetings will be the main events of the week.
Yeah, we heard a lot of crosstalk from ECB officials this week after CPI, their consumer price index, came out at basically a decade high. Now, decade high is like 3% in the EU, in the sort of disinflationary EU morass over the past decade. But obviously, cue the Northern European deflationists. They jumped out all over that number and said, "Oh, this demands a policy response. We've got to roll back accommodation and so forth." But we don't think that President Lagarde is going to play along with that. She has basically commanded the governing council with a pretty firm hand, and she has been unambiguously accommodative and cautious in her assessment of the economy. And she and her more dovish colleagues are echoing the Fed and characterizing inflation upside as transitory. And they really do have the data to back that up in a lot of ways.
Great. Thank you, Brendan. Thank you, John. Thanks to everyone for listening to the HPS Macrocast. I'm Matt McDonald, in for Tony Fratto. Have a great Labor Day weekend, everybody.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.